Blake, you were talking to me yesterday about an ASIC supply squeeze. Can you explain what this is and what's going to happen to the ASIC market going forward?
Yeah, definitely. I think, first let's kind of take a bit of a step back here and just kind of understand, where we're coming from in terms of the mining market. I think, in most markets, in most investment classes, it's really important to follow the leaders. If you're a stock trader like I am, you've probably heard that saying 1,000 times, right? Follow the leaders, right? You look to Nvidia and Tesla and Apple as a sense of where the broader market is heading. And I think it's no different in the Bitcoin mining ecosystem as well. I look to personally like the biggest Bitcoin miners in the world to signal maybe the direction that the market might be heading, right? What are they doing so that I can better, tell my clients what I'm seeing from the market and what I'm, looking to do with my personal fleet. I'm looking to the leaders and looking to the biggest miners in the world. And I think when we look back to the, 2022, 2023 environment, a lot of the pubcos were spot on, right? They were bearish on hash price, they were bearish on Bitcoin price. They were bearish on the value of their capex, right, of their hardware. And for that reason, a lot of them, were dumping older gen machines, buying, as efficient of hardware as possible. Those who were in a better cash position were preparing for the environment that we're now in 2024. So with all of that context, what are these companies doing today? Well, they're pretty obviously building out as much capacity as they can possibly manage to get, right. It's all public information, right. Go Google Clean Spark, go Google Riot. What are they doing? They're building capacity, right. Iris is doing it too. And with that capacity they need ASICs. So one of the bigger news stories from kind of Q4 early Q1 of this year was CleanSpark, for example, 160,000 S21 call option. So for context, for those who might not be familiar, big miners like CleanSpark in this example are taking a call option out with Bitmain, which means that in this specific example, we're going to buy 160,000 S21s at a fixed dollar per T price at any point in the next 12 months. Now, if you know anything about Bitmain, which I'm sure a lot of listeners don't, but some might, but Bitmain from what we've seen, they often like to take a little bit of risk, right? If that means they're squeezing out a little bit of extra margin. So do you think that when we're in this sort of environment where there's, pretty strong and growing demand for mining on largely an institutional level, but also on the retail level as well, do you think Bitmain's saying, hey, let's take $500 million worth of hardware and let's stick it in a warehouse for 12 months because we want to be prepared for when CleanSpark or Riot or Iris or any of these big miners say, hey, we want our machines? Do you think they're setting $500 million aside and then going and manufacturing new hardware for the smaller, secondary supplier, hosting provider, or even, the high net worth individual? I think the most likely scenario is that they're probably just continuing to operate per usual. And then at some point in the next 12 months, when these big pubco miners are going to call on those options, it's going to drag a lot of resources away from general production. And there's a pretty big possibility, in my opinion, that there's going to be a severe lack of fresh new hardware coming out of Asia for a period of time. So in the way I'm viewing the market and looking to the leaders, as we said, follow the leaders. There's in the future, I see a huge lack of supply that's coming to the United States, and it's kind of a similar environment to like the late stages of last cycle of 2021. If any of these, if anyone listening was trying to buy rigs back in 2021, you saw $100 a terahash for a 3 or 4 month futures order because they just physically could not manufacture as many ASICs as people were buying. Right. So I think it's a relatively similar situation potentially here in the next 12, 9, 8 months or so, because there's a lack of supply and there's only so many resources.
That makes a lot of sense. And Danny, I'm going to pass this off to you because Blake alluded to sort of the dynamics at play last cycle that caused machines to be selling for, $100+ per terahash. You were first entering Bitcoin and Bitcoin mining during that time. So how does that period really juxtapose to now? And, what were some of those like real driving catalysts that caused ASIC prices to just go through the moon during 2021.
Yeah, so think about and I like the setup on this, and Blake, I think you're spot on. Just to really quickly touch on that, and then get into what we saw kind of last cycle. Net is we're seeing big institutional miners build out a bunch of capacity, going long on space, building as fast as they can. That is similar to what we saw almost in a reactionary capacity, largely debt fueled in the last cycle. So we'll touch on that. That's a common denominator between last cycle and this cycle. Infrastructure, development, with a little bit more foresight and a little bit less leverage this time, so to speak. Right. And then to Blake's second point, you need infrastructure, you need energy, and you need ASICs to actually bring this to fruition. So they're going long on the infrastructure side, and then they're basically parking on the future supply, right? And we'll talk about some of the catalysts that could get those that would make those options likely to trigger, less likely to trigger, so on and so forth. But if you look at what happened in 2021, um, Bitcoin ripped in 2021. Then what, in August or so, July, August, we had the China ban. Bitcoin price action took a hit at that time, but we got this massive difficulty adjustment. So that was a relative wash in the short term. And for those who are mining Bitcoin with a long-term horizon, there's actually nothing more bullish than a difficulty drop, which, barring catastrophic or significant nation state banning of mining and so on and so forth, we're likely to see hash rate continue to trend up at a lower percentage increase, just because the law of doubling becomes harder and harder and harder, because you just need so much physical power, or physical infrastructure, and actual energy to facilitate that sort of hash rate, global hash rate expansion. But yeah, so we had a China ban, difficulty drop, July, August of 2021. Then Bitcoin started ripping into the end of the year. There were a ton of new entrants into this space. Additionally, all markets were ripping, capital markets were frothy. You had companies going public via reverse mergers, SPACs, so on and so forth, getting access to these capital markets. It enabled them to suck up a lot of supply. Core Scientific, for example, was making massive orders with a lot of debt, at that time. That ended up not being a great strategy. They went bankrupt. They're working their way out of it right now. It looks reasonably bright on a future looking basis for them. But what ended up happening is Bitmain, frankly, was not prepared for that amount of demand. Now, partially it's because they didn't see that amount of demand for ASICs. And also there were some existential circumstances like, COVID, for example, lockdowns, production decreases. There was a tariff war. There was a lot of stuff going on at that time. Um, but the result is, say, Q4, for example, we saw S19J Pros, which were effectively the tentpole miner of that cycle, priced at upwards of $100 per terahash. I think kind of on a retail mid-market basis, they peaked at about $120 per terahash, or $12,000 a machine, on 3+ month future orders for delivery, because that's where the supply was able to actually fill that demand, right? So it was a supply squeeze in different, what we're hypothesizing we'll see as we get into probably second half of 2024 this year, as these options get called on the back of price action. But the catalysts were a little different. And again, the catalysts were, maybe under preparation, and then some existential variables that were delaying the ability to meet production goals. But with any economic theory, supply and demand are the core principles. So if you have significantly more demand than you do supply, you're talking about making a physical product. That's not like, hey, we're going to, crank out an extra 70% of these on a dime because we've got all this extra demand that came out of the woodwork. That is highly premeditated, right? So I'll kind of pause there. I think that hopefully mostly answered the question, but we had a supply squeeze, right?
Yeah, I mean that makes a lot of sense, and I guess let's sort of focus on the demand side of that then. And the number one driver for demand for ASICs is going to be a running Bitcoin price. And obviously the last year and then the last 3 months of 2024 have been incredible for Bitcoin price action. We've already eclipsed new all-time highs, and we haven't even gotten to the halving yet. But we haven't seen similar price action from the public Bitcoin miner equities, nor have we necessarily seen ASIC prices start to respond as well. So, what are your guys' thoughts on that? Is the halving, fear of the halving, sort of what's keeping miner stocks and ASIC prices down? What's your overall take on this sort of divergence between Bitcoin price and mining related assets?
Yeah, I'll hit this one first, and I'll toss it to you, Blake, because I'd love to get your thoughts on it. But I think it's kind of twofold, sticking with these same themes. I think you nailed it, Mitch. There's an irrational fear of the halving, and we'll validate that irrationality as we look back at history, some of the catalysts. Like, guys, we're going into this having already touched all-time highs. Anybody who's mining Bitcoin right now with any modern ASIC, especially the next gen stuff like S21s or K Pros, is absolutely printing. Right, S21s at 7.5, 8 cents per kilowatt hour, probably something around $25,000 per production of Bitcoin, and that's 64,000 right now. So there's a huge spread, and even when that gets cut in half, we live in this Bitcoin denominated like go to the moon world, but hey, anybody catching 20-30% yield is stoked about that return, right? I mean, people look at a 7% compounding annual growth rate on personal investments as like the gold standard, right? If you can do it over time. So even when we get to that, it's gonna be interesting. So I think one, there's a bit of an irrational fear of the halving, and it's exceptionally irrational because the setup going into this halving is much different. We're already peaking, Bitcoin price relative to history, which is relatively atypical for a halving or shortly thereafter halving kind of time frame. Um, and then I do think that there's, in light of that fear, so to speak, there is a little bit of an over allocation of supply, or there's enough supply to meet the demand, and demand is stifled because of some of the, uh, some of the irrational fear that we discussed. Right. So I think those are two things, but also, we're going to hit the halving. Blocks subsidy is going to get cut in half. Bitcoin's going to be where it's at. And then that's a catalyst for Bitcoin price appreciation. By the way, the foundational setup now is built on the back of institutional inflows, which are driven by, high net worth individuals, passive inflows via the ETF. So the demand side is rock solid. And in conjunction with price action should continue to just increase in a snowball effect, right? And that's going to start to chip into the supply. So if you look at it from a Bitcoin mining equity perspective, this underperformance is a absolute like godsend of an opportunity as we go into the halving, and you look out 6 to 18 month kind of time frame. These are some of the best kind of technical and fundamental setups that you could possibly wish for as a trader or investor. What do you think, Blake?
Right.
Yeah,
What are your thoughts, Blake?
yeah. Just to kind of piggyback off Danny's points there. I think there's, I mean, several reasons that you could point to potentially why you're seeing this relatively recent underperformance from the publicly traded miners relative to what Bitcoin's done. I think part of it is you could point part of it to like FUD maybe surrounding the halving, right? You understand that these companies' revenues are going to get cut in half to some extent, right? At least mining generated revenues. You can ignore the AI revenues that some of these companies are starting to make as they diversify revenue streams. You can ignore demand response revenue, but there's that piece of the equation. But I don't think that a lot of these funds and institutions are generally super undereducated. I think when you go on Twitter and you talk to people in this sort of space, you kind of like to take jabs at the traditional financial space. But I think these analyst teams, these valuation teams are some of the brightest individuals in the world, and I think they have a pretty good understanding of the halving and how that impacts these companies. I think a bigger piece of it is just capital rotation and rebalancing, right? If you go back to 2020, 2021, and you were a equity only fund and you're seeing Bitcoin price action, outpacing every other financial product that you could possibly own, then what were you going to do? You were going to go buy Marathon, you were going to go buy Riot, you were going to go buy MicroStrategy, something like that. But times have obviously changed, right? You had the rollout of all these spot ETFs in the last, quarter, which offers a new product to those sorts of funds to gain directional exposure to Bitcoin price action. So I think you kind of have a rotation of capital out of those names. And I think that a lot of capital is still going to stick to those names, and a lot of analysts and institutions are going to be interested to own companies like a Riot, a CleanSpark, et cetera. But I think they serve different purposes, right? Running Bitcoin miners is a little bit different than just owning cold storage Bitcoin that you keep in the drawer in your desk, right? It's a different business case, and there's just different avenues to get exposure to Bitcoin price action. And I think that that sort of divergence is kind of in the infant stages of playing out. I also think it's just kind of been a interesting overall environment for the broader equity market, right? You had inflation numbers that came in a little bit higher than expected last month. You have future rates that are maybe a little bit higher than people had initially expected, right? Even the Fed Open Market Committee was saying this on Wednesday, on March 20th, if you're watching this later. I think the broader stock market's gone on an incredible run over the course of the last 12 months or so, and it's only natural that you're going to see some sort of digestion, some capital rotation, portfolio rebalancing, those sorts of things. But to Danny's point, I think it's an amazing opportunity if you're an individual who is long-term bullish on Bitcoin and in the broader digital asset space. It's just kind of this short-term digestion, rotation, rebalancing that probably injects a lot of fear into people.
Yeah, that makes sense. And I'm glad you brought up the macro, because to me, that's the most bullish catalyst right now, is the fact that rates are at multi-year highs, and Bitcoin and risk assets across the board have performed the way they have. I mean, I hear the term fiscal dominance thrown around a lot right now, and that's just true, right? When Congress is running multi-trillion-dollar deficits, global liquidity is going to increase. It doesn't really necessarily matter that the Fed has rates high. So once we get to that regime where the Fed actually starts cutting rates, which is looking like Q3 or Q4 of this year, I think that's where the fun really gets started. And in the meantime, this is kind of just the previews of what the real bull market's going to look like.
Yeah, absolutely. Sorry, Dana, just
No,
really
no, fire
quickly,
away.
like, obviously, in an environment where, you're coming off of an extreme tightening cycle historically, right? Where they increase interest rates at a, almost unprecedented pace. And then now we're reaching the point where rates are more than likely kind of at their terminal level for this cycle. You're going to have the tapering of QT or balance sheet runoff, and the Fed said this themselves. Essentially, Powell said this himself just the other day. But I think obviously that's bullish for risk assets in general, and it has been historically for a number of reasons. But I think specifically for Bitcoin miners, and one thing I like to focus on for a quick second is like the price of ASICs, right? The actual price that you have to pay to own a machine. A decrease in interest rates is bullish for Bitcoin mining prices, right? Because financing a rig purchase through debt is, I mean, relatively common, right? People ask me all the time, how feasible is that, et cetera. But as interest rates fall, it becomes more and more feasible and more profitable to finance a ASIC purchase, via debt, right? Via debt financing. So I think that this is just one of many catalysts that are showing that there's a ton of demand on the horizon for ASICs. And as we talked about earlier, there's potential issues with supply on the horizon for ASICs too. And it makes me incredibly bullish on, the future of ASIC prices, whether you think that's a good thing or not.
This video is sponsored by Stampseed. You plan on holding your Bitcoin for decades, so you need to make sure that your seed phrase is documented in something that can last just as long. Stampseed's signature titanium plates and stamping kits do just that. If you simply write your Bitcoin seed phrase down on a piece of paper, it's vulnerable to fire, water, and all sorts of erosion that can happen over time. Make sure you keep it secure for years to come. Head to stampseed.com and use the code Blockware15 for 15% off the entire website.
Yeah, man. Let's unpack that a little bit. I think that's a great topic. And the one thing I was going to add is like Bitcoin has done all this breaking through ceilings of all-time highs in a contractionary, monetary, fiscal environment, right? With like, there's a bunch of shit going on in the world still, right? Like, wait till we see an expansionary policy and things start easing. That is go time. So you've got all these macro and kind of industry native that are correlated accretive factors diverging simultaneously on what is practically, reasonably conservatively the second half of 2024, right? Now, right now, we're sitting in the end of the first quarter of 2024, and we're not there yet. But markets are forward looking. Monetary policy should be forward looking, right? It's it's you got to look at where the puck is going, not where the puck is. And where we're going is the confluence, the convergence of all of these bullish, catalysts, right? So let's talk a little bit, and Blake and Mitch, you guys probably help me out on some of the more specifics of this, but let's compare and contrast like S19J Pro pricing with monetary, not so much monetary policy, more like Bitcoin price action at the last cycle, about 4 years ago, going into the halving, around the halving, post halving, and look at price action and compare that to what we're seeing on next gen right now. So I'll give like directionally accurate broad strokes here. 2020 is a little bit of an outlier too, to some degree, because we did have a, major um, global event in the pandemic. There was that led to significant printing of money, but at a point in time, relatively close to the halving, like shit was kind of hitting the fan. So we got to take that into account as we analyze this. But S19J Pros broad strokes were like $2,000 a pop when they came out, approximately this time 4 years ago, right? And that's $20 a T as we, go apples to apples on this. As you look at, I mean, what did we get down to at the bottom of when, Michael Saylor adoption Bitcoin time, like sub 5,000 Bitcoin price, right? Which was well down from the peaks. So Bitcoin price action was down materially significantly at that point in time, and ASICs were $20 a terahash. Now difficulty was lower, hash price was higher. Those are factors too. So you could put a little premium on that and say, $20 per T for the same machine and the same setup, just difficulty being the difference is, it's a higher price right now. You got to kind of bake that in a little bit. And let's talk a little bit about how this played out. So Bitcoin then starts to rip, into 2020 as monetary policy loosened significantly. We're printing a bunch of money. Hash price rose because Bitcoin was significantly outpacing difficulty. Fast forward into 2021, you get, the Chinese ban, as I talked about earlier, and you get just exceptional price action into the peaks of 2021, right? Which was largely also on the back of a supply shock, uh, on the hardware side, as we talked about. And then also, I failed to mention, there was an infrastructure and energy supply shock too. People didn't have enough space built out, and there was significant demand for this space, largely driven by, freshly minted public companies that had access to frothy capital markets and great debt channels where they could raise a bunch of money quickly and deploy that into future, deployments, right? So you look at that and then look at it at a price action basis. S19J Pros popped at $12,000 a pop in that time period. So that's a 6x increase from the base on a 15 to 18 month time period. But don't focus on the time period as much, more about it's like, valley to peak, right? Bottom of the price action up to where we hit the peaks in November 2021, around 69,000. Okay. Now you look at where we're at right now. Again, before we're bad price action in and around the halving. And now we're looking at unprecedentedly good price action coming into the halving. And you're seeing, S21s, which are significantly more efficient machines, which mitigate some of that, difficulty increase, because these machines are much more efficient on the electricity side, and certainly on the output side. $30 a T for S21s, 20 something dollars a T for K Pros kind of life cycle. I mean, this is equivalent if you just kind of mark to market this, and Blake, I'm going to pass the torch to you here in a second, where if we're at peaks right now, maybe you give a 50% discount to the last peaks. We should be looking at $60 per terahash, S21s, but there's, future supply is not that hard to get to, and people are a little bit freaked out about the halving, which is just psychology. It's not rationality. It's just psychology. It's just fear. People are motivated, and people don't like taking action into fear generally, right? So I mean, I think is a demonstration of the fact that ASICs right now, relative to where the market's at, just on a present basis, not even factoring in all the future bases, which is actually where these things should be trading based on, are significantly undervalued, right? And then as you look at some of these things converging, first of all, we've got a rock solid foundation of institutionally enabled inflows into Bitcoin. I look at that more as just like a kind of high net worth individual, family office, passive inflow, 401k custodian vehicle, basically for Bitcoin, right? So those will continue and they will increase as we get positive price action because things are reflexive in that capacity. And we've got a monetary policy that is loosening as we get into these time periods. These are catalysts for significant price appreciation, which then should coincide, and we can unpack this a little further, with the public miners that hold these massive option calls, executing those calls. Think about this. They have a mandate to grow. Public companies, you got to grow. That's why they took on all that debt, in last cycles, because that was the fastest way for them to grow. You have to grow. And you have to grow at kind of all costs to some degree. That's the name of the game in public markets, right? So they are significantly motivated to execute those calls. They are, unless Bitcoin totally nukes down, which that could have positive catalyst too from I won't unpack that one yet. They're going to execute these calls. Then we go into the second half of the year and there's no supply on a spot basis of these machines. And infrastructure then starts to become in more demand, right? And then you've got this like perfect storm of raging price action outpacing difficulty, limited supply of next generation machines with reasonable lead times, right? There'll still be these machines on a 4-month lead time, but who the hell wants to wait 4 months? And a loosening monetary policy, which should, absolutely contribute significantly to the price action that will just catalyze this whole event. So net, and I'm going to get off this soapbox, is the best play is getting long the best mining rigs right now because they are underpriced objectively relative to historically where they should be priced and on a forward-looking basis. And then if you have a liquidity option, like for example in the Blockware Marketplace, I mean, I'll give one anecdote. In November 2021, Blockware Marketplace, which enables you to access turnkey miners that are plugged in, didn't exist at that time. We were selling 3-4 month future contracts of machines. And for $120 a terahash. If we had a spot vehicle that enabled capital allocators to come in and buy spot machines, we're touching like $200 per terahash for these machines. So if you're buying machines right now at $30-ish per terahash, and you're riding this cycle out, first of all, you're going to be carrying a nice profit through this upswing and lowering your cost basis. Then you're going to be holding the golden ticket that everybody wants. And if you get $100 per T, S21 pricing in Q4 with Bitcoin at 150 plus thousand, which is not totally untouchable by any means, you're crushed it. It's the trade of the century. Or you could just do nothing, but you're going to be holding all the cards, right? So that was a long speech. I just wanted to kind of unpack what I think we're going to see across the board. Love to hear your guys' thoughts.
I'm really glad you brought up the marketplace because this is what I've been thinking about throughout this conversation about supply problems and not being able to find a place to get your machine plugged in, having to wait multiple months to get your ASIC. This thing is going to be the platform during the bull market, right? Why would you wait 4 months to have a machine plugged in when you could buy one and have it plugged in 10 minutes as soon as your transaction confirms on chain? And then the optionality it provides to people that are buying machines now. Before, there was no way to capitalize on this volatility in ASIC prices, right? If you bought low, there was no market to really sell high into, but now that exists. So yes, you could still buy a machine and just mine it till the wheels fall off and recoup the value of your capex that way. Or you could do that for a little while and then sell your machine. So it really alters the thesis and your options as a Bitcoin miner.
Yeah, I think it just kind of opens up a ton of different avenues for, like Danny was saying, or in Mitch you were saying as well, is like there's all sorts of directions that you can then take, the investment, right? Do you want to sink a bunch of capex, depreciate it down to zero, and run your hardware until it's smoking and breaking? No problem. Do you want to trade the premium of the investment, right? The principal of the investment? Do you want to buy a bunch of cheap, distressed hardware that is more than likely going to be unprofitable here in April? But if you think Bitcoin is going to, who knows, 200,000, 300,000, et cetera, like it's a pretty good chance that hardware is going to be worth a lot more than what you paid for it. So you can, play that strategy too. Do you want to do what I think most individuals I talk to want to do, where you want to load up on the most efficient hardware you can while it's cheap, aka the last, 3-4 months or so, run that hardware for a period of time, 1 year, 2 year, 3 years, whatever you decide. And the best part about the marketplace is that there's no obligation to sell at a given point, right? So you can be objective and look to the market and decide things are getting a little frothy. You would rather, liquidate your position and hold spot Bitcoin that, maybe is a little bit more liquid. No
Yeah.
problem.
Let me add
Like
one
it
thing
just,
real. Or go ahead. Sorry, Blake.
please,
I got
no, go.
me thinking. I mean, okay, I like this continuum because we get asked a lot about, and frankly, on our marketplace, we see a ton of, transactional volume on, let's say, over the last couple months on what will soon be legacy rigs like S19J Pros, right? And so let's paint a continuum of hardware efficiency. And I want to bring immersion and some of the new technology into the picture too. And just to qualify immersion, um, it effectively, there's a higher capex, but if you're a capital efficient miner, with a hosting partner, that's not as much of a factor. But it's the best way to squeeze out the most terahash, right? And now technology advanced and firmware is advanced that enables you to squeeze out incremental, hash rate computations on without affecting or at least materially affecting your energy efficiency there, right? And I'll qualify this like in November 2021, hash price is super high. People don't care as much about the electricity consumption, like the electrical efficiency of a machine, because the spread is so high. You just want to keep throwing gasoline on it, right? So immersion was like big. Then immersion, I feel like, kind of took a little bit of a back seat, in the dark days of 2022, first half of 2023, because it was more about like controlling your costs. Okay. So if you look at this continuum, you've got on one end like S19J Pros that are really cheap right now, right? Like $1,000, let's say. Now, folks who have been buying those as cheap, premium call options on Bitcoin for the last 3 months have timed it really well, right? And if Bitcoin continues to rip, they're going to look great. I mean, you can ROI if you're making $200, dollarizing this a month, and you're spending, $800. Easier math for me. You got 4 months to ROI. That's awesome, right? But right now, these are not break even at the halving, with 7-8 cents hosting. So there's risk there. That's like the low premium call option into the spectrum. Then as you look at, I think we're going to see a big move uh, into like immersion type projects with some of the most efficient next gen ASICs. And particularly, I'm referring to like the M66Ss from MicroBT, right? And you can look at this back to Blake's follow the leader, this is what like Riot are doing, for example. They have a massive call on these units, I think more or less. There's a few different variants, right? So, and these are machines that are going to hash at, 18.5 to 20 watts per terahash, which translation is very, very efficient. And they're going to produce more than 300 terahash per machine. So these are like nuclear weapons on that end of the spectrum. And those are probably around $30 per T right now as well. So that's the other end of the continuum, right? You're maximizing your potential output while doing it really efficiently. And then you're preserving, like, pour some more gasoline on the fire opportunity as you look forward. So I think it's not just about like Bitmain S21s that are air cooled. I think we're going to see this is an unprecedentedly good opportunity, like looking at forward-looking data and leveraging historical, rig pricing, and looking at the fact that there's all these call options for future supply, which could trigger a supply squeeze. If Bitcoin price really nukes like we think it's going to, then it's going to be just like the biggest party of all time. But I think, the high upside, controlled downside for a little bit more capex, right? But people sometimes get lost in the capex. They're like, well, it costs more money. Yeah, but it's a better bang for the buck, right? Your upside is grander and your downside is less risky, right? And on a dollarized basis, dollar per T, it's like, 20, 30% higher. But that's the premium that you pay for mitigating risk while preserving significant upside. We're going to see moves to, S21s. I think K Pros are great too. Better, lower capex, right? Still very efficient machine, well in the money at the halving, at present market. But I really think we're going to see a big move to some of these immersion type solutions with, these 300 terahash esque machines. And I'll tell you, like, for those of you who mine, you'll know this. For those of you who don't, you will hopefully soon experience this. When you see, Bitcoin miners get plugged in and Bitcoin just accumulating in your wallet every day, and you see like you're cranking machines at 200, 300, 350 terahash, and how much profit and how much revenue and how much Bitcoin those machines create, it is magical, right? And then when that's happening into strong price action with a huge spread, you just feel like you got all the cards, you figured it out. But you got to be able to like swallow a little bit of fear and look at fear rationally and practically. Yeah, guess what? The halving is going to cut, block subsidy in half. That's going to happen. But on an adjusted basis, looking at history, these machines are like 50% underpriced. You're just not seeing it yet because we're not living in the 6 month from now future. But there's a very, 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 very real chance, based on price action, based on the macro landscape easing, based on in conjunction with both of those two things coming to fruition to any capacity, these options being called that will suck up all the supply, right? This is where you hear about blood in the streets. You get a blood in the streets opportunity on the price side, but there's not really blood in the streets. I think that's the analogy. There's not blood in the streets. People think there's blood in the streets, but we're basically at all-time highs right now. All right, I'm going to get off this metaphorical jam, but I don't know. Hopefully that is it. What do you guys think? Just perspective.
Right. Well, I definitely see the halving as sort of a buy the news event for Bitcoin mining related assets, right? It's going to be like this event happens that it's so scary and terrible for Bitcoin miners. And then after it happens, it's like everyone's like, oh, well, I mean, that happened and now it's not going to happen again for 4 years. So like we're kind of good. Like Bitcoin mining didn't die after the halving. It's not going to. Like you alluded to earlier, these new generation machines, they're going to be plenty profitable after the halving, right? The cost of production for an S21 right now is about 25 grand per Bitcoin. So assume that doubles to 50 grand per Bitcoin. That's still solid profit margins. And that's just with Bitcoin at 64,000. Ultimately, the way I really think about mining is these are the biggest Bitcoin bulls around. You're sinking all of this capital into hardware, into energy infrastructure, into land, and all of this stuff because you anticipate Bitcoin to run up so much that you're going to be basically printing money during bull markets. So if you're bullish on Bitcoin, like hyper bullish, you need to be Bitcoin mining in some way. You need some exposure because this is a way for you to capitalize on Bitcoin's price appreciation. Because I'm excited about the sort of difference between the velocity of price growth and difficulty growth. We've already seen from February to March, Bitcoin went up about 50%, right? We were at 50,000 about a month ago. We went up to 70,000. That's a huge run. You can't see that. It's physically impossible to see that growth in mining difficulty. And if Bitcoin goes from 70,000 to 150,000 within a couple months. I remember seeing a stat a few weeks ago. I think Dylan LeClaire put it out. The number of days from when Bitcoin makes a new high to when it's like 2x from where it's at. It's really only like a couple months. And
Mhm.
so you want to be in mining before that happens, right? You don't want to be the guy that comes to mining, in November 2021 and is buying on 4-month futures and you missed out on the bull market, right? So you want to get in now and capitalize before that rapid price appreciation happens.
And think about this one more just quick anecdote. Fundamentally what you're doing in mining is you're arbitraging energy using Bitcoin as the arbitrage vehicle, but net you are creating Bitcoin constantly at a discount to the spot price of Bitcoin. Then you have a strategy of, do I hodl all that Bitcoin and pay my operating costs with fiat, or do I pay my bill and then hodl the delta, or do I sell everything, right? Everybody can make up their own strategy. But if you come into one of these bull runs like this and you're creating $65,000, $64,000 Bitcoin at $25,000 Bitcoin, or 40,000 Bitcoin, or 50,000 Bitcoin, and you have that spread and you're hodling even just the profit that you're generating, and then we get to 100,000 Bitcoin, or let's just say 100% increase, 120, 130,000 Bitcoin, you also get the underlying appreciation on all that Bitcoin, right? And you get the uh, you know, price appreciation on these ASICs into a supply squeeze, right? So it's like the whole strategy is like asymmetrically, accretive, right? Like buying Bitcoin, great. Buying Bitcoin proxies, like, I think Bitcoin ETF is a great Bitcoin proxy. And there's different use cases to buy that. If you've got self-directed 401k, this is not financial advice. It's a very easy way to get access to proxy Bitcoin, through that custodian. Or if you're looking at MicroStrategy, for example, as basically a hypercharged Bitcoin ETF, or Bitcoin mining stocks, as we talked about, right? It's a blended portfolio that really captures like this asymmetric opportunity. But right now, the most bullish spot to be is setting up with a mining fleet, because you're creating Bitcoin constantly. You're at least holding the value of your ASIC, right? And if you go mine an ASIC for 6 months and you lower your cost basis by 50%, and the market stays the same and you can sell it for the exact same amount, which by the way, you're getting paid in Bitcoin, it's a better trade. So, I mean, there's a bunch of different factors that go into this, but this is an arbitrage opportunity. This is an information arbitrage. This is a fear arbitrage. The information is out there and it's not being taken. The market broadly is not taking complete action against it, which means that, that creates opportunities for those who are able to hold their breath and look a little bit downstream.
Right. Danny, you brought up a good point there that I want to harp on for a second. Why owning your own fleet of ASICs is a better way to get exposure to mining than buying mining stocks. Because for me, and I know a lot of Bitcoiners think this same way, like Bitcoin and cold storage is the ultimate goal. That's why we mine, right? We want to accumulate more Bitcoin than we otherwise would have. Having Bitcoin in self custody, that's quote unquote taking profits. And when you're mining, you're always adding to your Bitcoin in self custody, right? With the Blockware Marketplace, if you buy rigs cheap and then you sell them, you sell it and you receive Bitcoin immediately. So with public mining stocks, you're just like getting fiat number go up, right? But when you're actually mining the Bitcoin, you're getting Bitcoin number go up.
Yeah, exactly. I mean, I think there's everybody's got different reasons for deploying different strategies, and I personally do think that Bitcoin mining stocks are really good, especially right now in light of the same kind of backdrops here, as a part of a portfolio, but let's think about that. I think that they're good parts of our portfolio because they are going to execute the strategy, tactically that we're talking about from a mining perspective, right? And they have different treasury strategies, executive compensation strategies, capital raising strategies, dilution strategies, debt, leverage strategies. Like there are some strategies that are out of your control that are beyond just like plugging an ASIC in, having a sound operating partner, and you control the destiny at that point. Bitcoin mining stocks are going to go up, in my opinion, because Bitcoin is going to perform well, and uh, the profit that these Bitcoin mining stocks will yield will increase. So like you can just do that. You don't need a Bitcoin mining stock to get exposure to that value appreciation. You can be a Bitcoin miner. You can run the Bitcoin mining playbook. You can go buy M66Ss in immersion mining like Riot. You can go buy S21s in air-cooled environments, right? And now you have the added benefit of being able to execute a sell on those assets whenever you want. It's an option. It's not an obligation. It's like a run pass option. It's like the new NFL quarterback, right? So, anyways, that was a longer speech than I thought, but I mean, just you can either like get on the back of somebody else's strategy, which is a fine strategy if it's a winning strategy, or you can run that strategy yourself, or you can do both. But you shouldn't not run that strategy yourself because that's where a lot of the alpha is.
Yeah, I agree. Boys, this has been a great conversation. If someone's hearing this and they want to start mining Bitcoin, who should they talk to and where should they go?
Yeah. So, Blake, take that one.
Yeah, no, you can always email me personally. It's Blake at Blockware Solutions. You can hit up sales at Blockware Solutions. You can head to our website. We have a sales contact form, get you directly in touch with our team. Definitely, find us on Twitter, find us on LinkedIn. There's 1,000 avenues to connect with us. And, we're certainly happy to jump on a call and talk about this some more.
Yep. Great. Thanks for putting this together, Mitch. It's really fun.
Yep. See you guys.